For more on the current state of the commercial market, let's get to Diana Olick, who joins us with the CEO of BXP, a company formerly known as Boston Properties, the second largest office REIT in the U.S. Diana.
Well, thanks, Mike, and thanks to Owen Thomas for joining us here. You just heard the stat that we've reached yet another high vacancy rate, and yet BXP's is almost half that vacancy. So what do you attribute that?
Bifurcation in the market. There's premier workplaces and there's everything else. Premier buildings are 5 to 6 percentage points. The vacancy's lower. There's net absorption of, and by the way, the premier workplaces are defined as the top 10% of buildings. There's positive net absorption in those properties. It's very negative in the rest of the market. Asking rents are 50% higher. The predominant, our buildings are predominantly in that premier workplace segment, and that's why our vacancy rate is 10 to 12% as opposed to what the market vacancy rates are.
And you're also getting 91% of your rent from central business districts.
That's
now,
correct.
We talk about return to office, and in the East Coast, it's actually doing quite well. You're seeing New York, Washington, Boston doing well. But you have properties on the West Coast, San Francisco, LA, not doing quite as well.
Yeah.
So where are we in return to office?
Yeah. So we have badge counts for half of our buildings, and we compared them to what they were pre-COVID. New York is back 100%, 3 days a week. Boston's 85%. The West Coast is only at about 50%. So you're right, and it's primarily due to the fact that the technology clients are a bigger portion of the market share, whereas in the East we have more law firms, financial firms. They're coming back to work more. However, we think that leasing volumes are more driven by corporate earnings growth than by return to the office. So what do I mean by that? Well, our leasing slowed down in 22 and 23 because in 22 the S&P 500 earnings growth was about 4%, and in 23 it was flat. But in the first quarter of 24, it's up about 4 to 5%. And guess what? BXP's leasing activity is taking off right now. We're seeing a significant increase in the volume of leases that we're signing and negotiating, even in the last couple of months versus 3 and 6 months ago.
And you're acquiring new buildings, taking office market share. Is that because of distressed properties? You're getting them at good prices?
Well, at the end of last year, we bought in joint venture interests in 3 buildings that we already owned from joint venture partners. We thought at very interesting prices because those joint venture partners no longer wanted to invest in office. So again, time will tell, but we think those were, very exciting opportunities for us and our shareholders. And we're continuing to operate in traffic in the market today because, as you know, many buildings are getting foreclosed on. There are many institutional owners of broad portfolios of real estate that want to downsize their office exposure, and we're pursuing opportunities in all those sectors to try to find things for the company.
Right, and you need capital to do that. Now, talk to me about market pricing right now, because a lot of people say office has not been repriced exactly, especially in the areas that you're looking at. So what about office pricing, specifically at the property level, and capital on the sidelines? Is there, where you're getting your money from private equity, you're not going to the banks. Is it available? Is there dry powder waiting there?
There are a handful of deals that have been consummated in the country that I would say are at very distressed kind of per square foot values, big discounts to replacement cost. These buildings are not super high quality, and they're also not very well leased. There actually haven't been very many trades of what I'd call the premier workplace high quality assets. There are definitely private equity sources of capital that we work with that would be interested in joint venturing with us for new acquisitions.
And higher interest rates for longer, how is that going to affect you?
Well, it does impact. I mean, the 2 big drivers for our performance are interest rates and corporate earnings growth, and I talked about the earnings growth issue. Look, I think the issue on interest rates, I don't think they're going up. I can't tell you when they're going to go down, so it feels like a factor for us that has limited downside and certainly upside over time. I just don't know when.